Oh, okay. Well, look at that. We have just a couple of minutes, so we are not starting here for another 2 to 3 minutes. But this is the tax reform update and its impact on real estate. We're super excited because we have almost 400 people registered today, and really excited to be doing this webinar with tons of our good friends and clients. I see a lot of familiar names in there. So while we're waiting, jump over in the chat box. Tell us where you are dialing in from today. It's always fun to see where everybody's coming in from. Philly. Kim shouldn't get Philly. Not at home today.
I should be home today.
Heidi, can you hear me okay?
Sure can. Hi, Ryan. Thank you.
Sure.
Good. So I should be sharing my screen. So make sure everybody can see the slides. And then for attendees, if you guys can confirm that you can see the slides, and we should have cameras on. So we've got an amazing crew. I'm so excited. We've got Kim Lochridge, Julio, and Ryan with the Real Estate Roundtable. What an amazing like VIP cast. Super excited. So we've got one more minute before we will begin.
Well, whoever just passed on the peace sign, I appreciate that. So.
Yep. For everybody in here, find the chat box. Let us know where you guys are all dialing in from. I'm sitting in Las Vegas today. Kim is in Philly. Julio, your home office in West Palm, right?
West Palm Beach today.
Nice. Perfect weather?
Yeah, pretty good weather. Ryan, I'm coming to DC in just 2 weeks, so hopefully I can come by and say hi.
Yeah, I hope you do.
Nice. Okay, well, it is 10 a.m. Pacific, which means it's what, 1 p.m. Eastern time. I think we've got people here from all over the country. We have a lot of people jumping in right now. The attendee count is just climbing by the second. So we're going to kick this off and get started. Please confirm if you're in here. There is a chat box. You should be able to make some comments and questions. We have a Q&A box as well where you can drop some things. We have people from all over the country. So we've got Houston, Texas, Boston. Thank you so much for confirming the slides are up. Someone asked the question, are we recording? Which yes, we are recording, and we will make sure that this is available afterwards. So we'll send out links for the recorded webinar. Anybody wants to share it or re-listen. We do not have any handouts for the webinar at the moment. And we've got Jim from DFW and all over. So look at this. Thank you so much for the comments. Feel free to use that Q&A box as we move through this presentation. We will have a Q&A session as well and answer questions. Also, if you're looking for an answer from someone specific on our panel, then make sure to put that in your question. So if you're wanting Ryan to answer a question or Julio, just make sure and be specific, and we will make sure that they get that question and can address that for you. So with that, let's get started. This is exciting. We have 1 hour. We are offering continuing education credits for this. So we will be running poll questions. The first poll question that we're going to run is really about what is your profession and what's your area of expertise. So we'll pop that question up. Amina's here and should be able to pop up poll questions. Make sure and answer the poll questions so we can issue your continuing education credits. Going through first our list of panelists, our speakers today. Julio, if you guys don't know Julio, I don't know how you don't. So Julio is our fearless founder and CEO, national tax advisor to Congress and Senate, and very instrumental in the One Big Beautiful Bill on the tax committee, which is amazing. He's grown ETS with acquisitions. He's led specialty tax and CPA services for over 25 years just within our company since he founded it. And of course, longer prior to that. Named top 100 most influential in accounting and honored as one of Inc. magazine's 10 most dynamic business leaders. If you don't follow Julio on Instagram or social media, you should. Tax reform expert. It's always fun, and he always shares a lot of really great information about grants and tax incentives and opportunities for investors. As well, we are offering a free copy today of Julio's new book, which just hit the bestseller list, Why Billionaires Love the Tax Code. This is on Amazon, and we are, again, sharing a free copy. The link will be shared in the chat. So we'll put that in the chat box. You can click that link, enter your information, and we'll send you a PDF version of the download book. So Julio, congratulations on the launch of your book.
Oh, thank you. I mean, it has a lot to do with, real estate and, and I'm so thankful for Ryan to be on this webinar with us, because him and his group are really responsible for the real estate section of the new tax code, which could have gone either way, but I think they did a tremendous job of making it just about as outstanding as it could be. And they are always helping our industry. I recommend if everyone get to go to their website and get to know Real Estate Roundtable, because they're so critical to our country and our economy and how real estate is dealt with in our country. So, we're really proud to have Ryan here. He's probably the most influential person in real estate.
I know it is such a privilege. So we'll get to Ryan's background here momentarily. So we also have Kim Lochridge, who is the CRO of Engineered Tax Services. Kim's been a real estate investor since the late 1990s and combines her management and deep experience in real estate and energy tax, 25 years of entrepreneurship. Kim also, so I'm a little biased, Kim is my sister, if you all don't know that. So we are sisters. We've been working together for almost 15 years. And you know what, if you don't know anybody that is maybe the most dynamic, entrepreneur-driven, hardworking person, Kim is the top of the, literally the what do we call it? The pinnacle. So the pinnacle of that and success. So her expertise is absolutely unmatched in this industry. And then finally, Ryan, and Julio gave some background. Ryan, thank you so much for being here, the Senior VP and Counsel of the Real Estate Roundtable in DC. 11 years as U.S. Senate Tax Advisor. He was the staff director, former tax lawyer, established a real estate research consortium at the Real Estate Roundtable, and serves on the tax and sustainability committees for the Real Estate Roundtable. He studied at Georgetown. And Ryan, thank you so much. It's truly a privilege to have you here, and your insights and giving us kind of the behind the scenes, I think, of what happened with the tax bill is so valuable to our guests.
You're very kind, Heidi, but I don't miss an opportunity to be on a panel with Julio and Kim. So it's always a lot of fun, and they are real experts. And Julio was very complimentary at the roundtable, but the roundtable consists of people, of which Julio is one of them. So it's a small group of real estate leaders throughout the country, and we rely on those members for what we do. And Julio's expertise and Kim's and are a big part of the reason we're able to do what we're able to do here in Washington. So thank you.
Amazing. Thank you for the background. Your group and your organization really is pretty incredible. And I know that Julio and Kim have been absolutely thrilled to be a part of that for many years. So with that, let's dive in. Oh, yes, myself. Hello, I'm Heidi Henderson. I'm kind of moderating our presentation today. I have a master's degree in tax, also in real estate investing and tax consulting, now with ETS for about 14 years, and working with investors, CPA firms, business owners, and now actually not Utah and Nevada. I'm based in Las Vegas full time. So I always tell people, next time you're in Vegas, give me a shout. I absolutely love being here because I get to visit with people in person all the time, because who isn't in Vegas once a year, at least? So absolutely love that. With that, let's talk about what's in our agenda. So number one, bonus depreciation. The poll results of the first poll of who is our profession. 54% of you are CPAs today here. 25% is actually real estate investors. The next poll question is up, kind of looking at what are the topics you're most interested in today. So bonus depreciation is always top of mind for real estate. We'll talk a little bit about the changes that have occurred with the One Big Beautiful Bill. Qualified production property has been one we've had a number of questions on. Business interest deductibility, low-income housing opportunity zones, clean energy, and the SALT deduction, and mortgage interest deductions. So a lot of those things. The poll question is great. 25% of you guys are interested in bonus, but 71% want to hear all about all the things, which we kind of assumed would be the case. So we're going to dive into these. Obviously, we have an hour today. There's a lot to cover, and we really want to run this as a panel session in discussion points with Kim, Julio, and Brian, and dig into what the One Big Beautiful Bill has done, how this is going to impact real estate, and the benefits that it is offering for real estate investors and for your clients, for those CPAs that are here. So bonus depreciation. Who wants to dive right in to what's happened with bonus? Kim, you want to hit this one first? Then we'll have Julio and Ryan provide insights on how this progressed.
Yeah, this is great. So, we waited for the bonus depreciation to come back, and thanks, Heidi, for all the great introductions, and for setting this up and putting it together. We're really excited about being here. The bonus depreciation has been, something we waited for a long time. American Families and Workers Act, it was supposed to be in there, then that bill didn't pass, as we know. So we kind of waited a couple of years. As we know, the sunsetting started in 2023 after the Tax Cuts and Jobs Act, and once the BBBA bill passed, then it was able to give us the 100% bonus depreciation back for a property that is in a recovery period of 20 years or less. So those buckets, 20 years or less, typically your 5, 7, and 15-year assets can now be 100% expense. And that has, there was one big change that was not there previous. The prior to that, the bonus depreciation applied to a placed in service date, and that was the triggering of what percentage you would apply to each individual year. One of the big changes was that they actually added one word that changed the whole definition of it, and that is the acquired and placed in service date. So they went from just placed in service date to acquired and placed in service, and that property has to be acquired and placed in service after January 19th of 2025. If it doesn't meet the acquired and the placed in service dates, then we have to revert back to the Tax Cuts and Jobs Act. It doesn't mean they don't get any bonus. It could mean that they get 60 or 40% depending on the year. But in order for the 100% to be accurate, you have to have the acquisition and placed in service date after that January 19th placed in service year. So anyone want to chime in? We can do a round robin on that.
Yeah, I would say that the one thing that is not shown on this slide is that, and this is phenomenal, that it was made permanent, right, Ryan?
Yeah.
I think that's correct. So permanent is so great because for the last 20 years, if we had bonus depreciation, it was 100%, then it'd go to 80 and 60 and 40. It always had this, back and forth, and it was never permanent. And so CPA firms, real estate investors couldn't really plan, because it was always changing, always moving. Now it's permanent. I think that's phenomenal, right? So now we know that when we're investing in real estate and doing the cost segregation studies and taking 20 to 40% of the building and putting it in this bonus depreciation category, it's 100% and it's permanent. And maybe Ryan can share how it became permanent, but this is, I think, the fantastic thing.
Yeah, if there was ever a provision you'd think they might not be able to squeeze into this bill, it would have been this one, because it's hugely expensive. It's like over $300 billion over a decade to make 100% expensing permanent. But they really achieved this for just about everything across the board. And this one is, as you said, Julio, probably the most significant. I just know for real estate, this issue has really been a long trajectory, because for years we were fighting over what qualifies for bonus depreciation. And that had revolved around leasehold improvements for a long time. And then that got made part of bonus in 15-year. And then we were able to kind of expand that out to qualified improvement property, which now, covers much of what happens on the inside of any non-residential building. So this is a really important provision for real estate, as you note. I mean, there's other, I'm sure we're going to talk about this, but there are other issues that come into play with whether you can actually use it because of rules related to business interest limitation in 163J. But obviously, real estate is an enormously capital intensive industry, a lot of CapEx. And so the ability to be able to expense those from a cash flow standpoint is enormous. And so this is a very significant change, and very happy to see it in the bill.
Is there any insights of it was really interesting because I think when all of the drafts came through, this was going to extend 100% bonus for 5 years, if I recall. And then it was like right at the last second, like the Senate, I think, changed it and made it permanent. Does anybody here have any insights of like what that discussion was and how, like, I'm fascinated by essentially how that happened. And did it just sort of get slipped in like right at the last second, or what was that change?
The Senate kind of drew a line in the sand very early in this process and said its number one priority for everything was permanence. And you combine that with the fact that they didn't really have a hard and fast limitation on what the cap of the size of the tax cut was, because they were playing along with these baseline games that would allow them to basically increase the size of the overall bill. So it was really whatever the politics would allow for. And, I think the administration, I think the White House was happy to go big with this tax cut. The Senate wanted to go big. And there are a few holdouts in the House, and they really, at the end of the day, I mean, I think we're willing to go along. The president's very popular, and this provision is very popular, and nobody wanted to really stand in the way there. So I do think it came in late, and I think that's because the whole process was House focused for months, and as is often the case, the Senate kind of gets the last word, and it really got the last word on this bill because the House didn't change it after the Senate passed its version, and that was the end of the conversation at that point.
Yeah, interesting. Well, thanks for sharing. I was kind of curious how that kind of all went down. Kim, back to you on a question as it relates to that one term that they put in the bonus rules, which is being acquired and placed in service. Can you talk a little bit about the actual impact and give some examples? Because this is one we're dealing with a lot, and I've actually seen a lot with the CPAs where the CPAs haven't caught that one piece. So I think since we have a very high percentage of our CPAs and tax professionals on this webinar, can you talk a little bit about what they can be looking out for and why this matters?
Yeah, so it is a big change from what we're used to, because it has been just when it was placed in service, but now it has to be acquired and placed in service. There was a question in the Q&A box, and they said, if you acquired an asset in 2024 and then it was under construction 24 and 25, and then you put it into service in June of 25, and it was available for rent, does that make a difference? And it does, because again, we go back to that acquired date was before January 19th of 25. So you would actually revert back to the Tax Cuts and Jobs Act rules, which the placed in service date is 2025, which means that would be eligible for 40% bonus depreciation, not 100. And just want to be clear, the 100, you're still benefiting quite a bit. You get 40% up front. The other allocation, the other 60% gets allocated among its 5 and 15-year buckets respectively, right? So you're still getting it. A lot of people can't use all the bonus depreciation in the first year anyways, so it's okay. It's not a huge hit, but although, the bonus depreciation on 100% is extremely beneficial and allows you to do some additional tax planning around it. So, just pay real close attention to the acquisition date and the placed in service date. And remember that if it doesn't hit both of those points after that magic January 19th of 2025 date, then it has to revert back to the old Tax Cuts and Jobs Act rules and give you what that was previous. So it is important, and those are just some examples of that.
Perfect. Yeah, thanks for sharing. Because yes, that's one we're running into a lot.
Yeah.
So now on to the next provision that's also been something I know I've had a lot of questions on, and it's qualified production property and factory expensing. So as I understand it, this is pretty interesting. There is the potential that for qualified production property, that the entire property, like a building, could actually be fully expensed under the bonus depreciation rules or qualified production property rules in year one. Anybody want to expound here? I'm not sure, Ryan, if you've been involved in this component of the bill. Do you have something you want to?
So this is I mean, I'll say a couple of things. I wouldn't say I've been extremely involved with it, but this really came from the administration and the Treasury Secretary. And it's really about reshoring investment from outside the U.S. And that's what they're focused on. The whole tariff policy and trade policy is all about kind of bringing back a lot of manufacturing activity to the U.S. and they're hopeful that this contributes to it. I guess the one challenge we see here is that we think that a lot of small and mid-sized factories, manufacturing facilities are not owner-occupied necessarily, but are built by property owners and leased to manufacturers, and those don't really qualify as we understand the language. At least maybe ETS has found a way for that to work, but I think it's very challenging for leased facilities to get this expensing benefit. So my guess would be the largest users of this are going to be really the largest production facilities, like auto plants or really giant manufacturing facilities. It will be very interesting to me. Is this something that can be expanded to somehow made to work for least qualified production facilities, or basically how they're going to deal with that issue, or is it really going to generate the tax benefit that the scorekeepers seem to think it's going to? I mean, I keep coming back to revenue, but it has an enormous revenue estimate associated with it, $140 billion just for 100% expensing of factories for a fairly short 4-year period of time. So I'm not hearing from a lot of roundtable members an ability to really make this applicable to their activities. I mean, it certainly doesn't apply unless you really are involved in production, and they have strict guardrails associated with what is, what kind of manufacturing and production activities qualify. So I don't think it extends, for example, very easily to industrial property that's logistics and distribution facilities and data centers and stuff. But there is someone out there that's going to be able to make this work. I'm curious to hear what you all think and based on it so far.
Yeah, so I completely agree. And we have a lot of investors who I've had a number of investor conversations recently of people looking to acquire large manufacturing facilities as a property owner who then is leasing that to a manufacturing company and explaining that, look, that's not applicable in that sense. But we also have a number of manufacturing businesses that we help with the tax credit incentive side. And I'm interested in Julio's perspective on this, particularly as it relates to this, I think, coupled with the changes in the R&D tax credit. Now, we're not talking about R&D credits on this. We're really primarily real estate focused on this webinar. But for 30 seconds, the R&D tax credit, one of the biggest changes is the dismissal of amortization for qualified research expenses. But for foreign costs, it still has to be amortized for 15 years. US-based costs are expensed in the current year. So again, this administration put a heavy emphasis on supporting US-based manufacturing and incentivizing big industry, big companies, small companies to build manufacturing facilities and even invest in their own properties now because of this provision, providing the potential for really dramatic tax incentives. Julio, have you looked or seen anything, or what are your thoughts on what you think is going to happen over the next 4, 5, 6 years with U.S. manufacturing and real estate and R&D and all that?
Yeah, I would kind of reiterate what Ryan said. When I talked to Chairman Jason Smith, who's the head of Ways and Means, and then, talked to Crape over in Senate Finance, they both thought it was pretty expensive. I don't think they wanted it either, but they really thought that, it was coming from the administration, right? That this was going to get in because of the administration. And, it was surprised because it was expensive. And ultimately, though, they thought it was going to bring back and attract, big corporations to do, manufacturing here in the United States. I think Ryan's right, though, with that exception, it becomes a little bit more difficult for people to use. And, will they clean that up? We have a government shutdown coming. If we don't, do the budget, and can they slip it into another bill? I doubt it, right? I don't think anything else gets passed, from a tax perspective going forward. But I think, that's what happens, right? We pass tax law or tax code, and then we kind of see, like, how is it really being implemented? How is it being used? Can we make some changes? And maybe we get some changes there and some relief for people to really take advantage of it.
Yeah, absolutely. Kim, any insights on the qualified production property with any of your clients?
Yeah, I had a recent case. The CPA reached out to me asking about a project that was going to be in the works for construction, and it was a manufacturing facility. And we talked about kind of what would be eligible for that. They decided, after we discussed it with them, that they were going to build two separate buildings, one specifically just for manufacturing, and then one that would be separate for office. That way, they can expense the entire amount of the manufacturing facility, because it doesn't count mixed use areas, right? That it's solely just the manufacturing. And so I do think we're going to have some court cases on this. I think the people are going to push the window. I saw that there was a question in here that, data centers cannot qualify for QPPP. So, I think we're going to see some people trying to push some windows and say, well, we're manufacturing this, or manufacturing that. But I think the bill's pretty clear about what is allowed and what isn't allowed. So I think it's going to be interesting to see how people incorporate that and to see how the IRS responds to it.
Kim,
Yeah.
if I could just add, what I'd like to see is, I'm sure the administration is looking for some really splashy announcements about big reshoring of major manufacturing, but we're going to try to get them to buy into this idea that this should be something that's available for the smaller and mid-sized manufacturer as well. Because I don't think that's so deliberate. I think it's just wasn't where they were necessarily focused. And unfortunately, I don't know that the legislation, that it's drafted in a way that the regulators could do that. It does look like it probably has to go through legislation, but leased facilities is going to be a priority for us for sure going forward.
Yeah, that makes sense. Okay, so now into the business interest deductibility. Who wants to dive into this one a little bit?
Ryan, you want to start on this one?
Yeah, I'm happy to talk. So on 163J, which is a limitation on the amount of business interest expense that can be deducted. We came in 2017. It was a big pay for the overall, basically the corporate tax cut and all the business tax relief. This was one of the biggest tax revenue raisers in the bill, limits the amount of business interest expense you can deduct on an annual basis. We were very concerned about this from the real estate standpoint, because obviously you borrow a lot to purchase real estate. You tend to have significant debt load on any property, usually for commercial property. So we negotiated out of it and basically got an exception from the business interest limitation for a real property trade or business. But that kind of comes with a penalty, which is if you opt out of the limitation on business interest expense, you don't get the benefit of bonus depreciation. You're pushed into the alternative depreciation system, so you don't get to deduct immediately expense what would otherwise be eligible for bonus. You're in slightly longer cost recovery schedules for your residential rental and non-residential property. And so that's kind of the what you bear as a real estate company or real estate taxpayer if you opt out of the business interest limitation. There was a short period of time after 2017 where that interest limitation did not bite so hard. And that was just the way they defined adjusted taxable income, basically made it not as harsh a impact. And so a lot of taxpayers didn't have to opt out of it. Unfortunately, that expired, I believe, in 2022. It was in effect for 4 years. What the legislation does is revives that more generous rule that was in effect from 2018 through 2021. So basically, more real estate owners can operate under the general rules in 163J that put a cap of 30% of your income being able to be business interest expense. The definition of what is your income is broader, so your interest expense limit is higher. And this is done on a permanent basis. It's a really positive thing. There are some issues we want to work out, and one of the biggest ones is allowing taxpayers to modify the elections that they made. So if they elected out of out of 163J previously, the provision has gotten softer, not as harsh. If they want to change their election and get back into it so that they can use bonus depreciation, that's something that we're going to push hard on Treasury to allow taxpayers to do. They did do that in the CARES Act of 2020 when qualified improvement property was made eligible for bonus, and some other changes were made. So I think we got a good shot at that one. Unlike factories, I think that we could make some real progress in making the 163J provision even better for property owners. But that's the gist of it. Hope that makes sense.
Yeah, absolutely.
Yeah, and I wanted to just add to that too. Even if you do, take that business interest deduction, and now you're required to file your depreciation under the ADS rules, still do a cost segregation study, because we can carve out the assets from the 30 or 40-year bucket into like 9 and 20 years. And so you can still take that even though you're not eligible for the bonus depreciation. So there are ways to kind of get benefits of both. And a lot of people just think that if you're taking that business interest deduction, then you shouldn't do a cost seg because you can't get the bonus. But you can actually do both. You just don't get the bonus, but you still carve out, which really helps on state returns, right? Because if you can adjust those class slides to the 9 and 20 instead of 5 and 15 under makers, it does give you the benefit of shortening that period of time that you can depreciate certain assets. And then you don't have to worry about the state that doesn't acknowledge or recognize bonus depreciation. You're still getting kind of the best of both worlds. So all's not lost if you're going to take the 163J, because you can still do the cost seg and be able to carve out some of those class lives.
Perfect. Awesome points, Kim. Thanks for the insights on that. Ryan, I think your group is pretty instrumental in the low-income housing tax credit side. Am I correct? I think that's something that a lot of your members are pretty active with.
Yeah, I would say thank you. There is a large community of organizations and real estate groups and stakeholders that care a lot about the housing debate and affordable housing, including producers and owners and developers. The Roundtable, National Multifamily Housing Council, National Apartment Association, National Home Builders are all really active on this. And so housing is just a perennial issue, and just feels like the cost, keeps getting worse and worse for a lot of working Americans. And so we believe that it's primarily a supply-driven problem. And restrictions on supply, restrictions on the ability to develop, et cetera. A lot of the problems is state and local in nature. We can't necessarily change all those at the federal level, but we do have some good programs that go back to the 1980s, most significant of which is the low-income housing tax credit, which has produced like 3.7 million homes since it was created. But the limitations or let me say, the allocation of credits to states has been pretty stagnant for a period of time. There is a temporary period where it increased a little bit for a few years, but there's been a bipartisan effort to basically make a number of policy reforms to the low-income housing tax credit. And some of those got included and pulled across the finish line in this legislation. Basically two provisions, an increase in the allocation of credits to states just across the board of 12% on a permanent basis, which is, another permanent provision that's very good to see. And the other one, which is probably going to have a bigger impact, is a lowering of the threshold for private activity bond financing. So projects don't have to actually get an allocation of credits from their state housing finance agency if they have tax-exempt bond financing, private activity bonds. And the rule had been that 50% of the project had to be private activity bond finance. This lowers it to 25%. And that's just going to basically make it a lot easier for a lot more projects to qualify for what's called the 4% LIHTC credit. So I hear a lot about that provision. I think it's going to be very useful. I would say there's a lot more that needs to be done here in affordable housing, and maybe I'll just use this as a quick opportunity to pitch something that we've been focused on, which is commercial to residential conversions. We're trying to kind of get that into the affordable housing debate as well. And maybe we can come back to some of this stuff, but there is hope for more housing legislation. The president's talking, and Treasury Secretary is talking about a national emergency on housing being declared potentially in the coming weeks. It'll free up more opportunity. One other thing on LIHTC, I would say there was just within the basically last month, Fannie and Freddie announced that the Federal Housing Finance Agency that oversees Fannie and Freddie, increased the caps on how much they can invest in LIHTC from $1 billion to $2 billion each. And that's going to have a lot of impact on equity investment in the low-income housing tax credit. So there's just a lot of different issues and challenges associated with housing supply. Could talk about rent control, could talk about all kinds of things, but these supply incentives are hugely important, and we're really happy to see an investment being made in the One Big Beautiful Bill Act.
Yeah. So question, I know in the Biden tax policy, he added a lot of provisions for prevailing wage and apprenticeship hours and kind of creating like a jobs bill and wage bill sort of coupled in with some of these provisions. And we'll talk a little bit about 179D deductions, which was really impacted by that. Did the low-income housing tax credit also get impacted? Are those same requirements applied on these to have them qualify?
Yeah, no, those you're right. I mean, and there has been concern, and we know that there are stakeholders out there that would like to see some of those wage and labor rules kind of extended to credits like the low-income housing tax credit. That has not happened yet. Okay. We're also concerned about that kind of coming in through Fannie and Freddie as well, in their lending programs, basically imposing those similar kinds of requirements. So far, it's been mostly in the energy area, and not as much in housing. I think there are some that apply to the energy efficient homes, new homes credit. But,
yep. Yeah, exactly. Yeah. Julio, how do you see the low-income housing credit kind of couple with all of the different incentives that can roll into a project? I mean, that's something you've been really so involved with in helping developers and investors understand how to really stack all of the opportunities to help fund these projects and improve ROI. So can you talk a little bit about how it all kind of rolls together?
Yeah. And first I would say that this one, didn't look like it was going to make it. And I think Real Estate Roundtable did a tremendous job here, at least with these credits, getting into the bill. It was this was one of the ones that was in, it was out, and there was more out than in. And so Ryan, good job to you guys. And you're right, Heidi, we have so many state programs and that match the federal ones, right? In DC, there's, where Ryan is, there's really strong local programs as well that come to it. And we're seeing now that there's a lot of grant money set aside in addition to the state incentives and the housing federal incentives that, really help these projects get done. I can tell you that there's a bunch getting done in DC right now, just because of all the state and grant and incentives. And the grants are local, state, federal. And so, putting those all together, it got a lot of attention at the state level too. I know we're talking about federal, but state and local and grants. So when you put those combined, it's really helping get some projects done.
Really cool. Yeah, that's some pretty cool insight. I'm not as familiar in that area, so it's interesting. Diving into opportunity zones. So this is interesting. I mean, opportunity zones were coming into a phase where essentially they were expiring or are expiring next year. And now they've made these a new permanent provision, and they're expanding all kinds of things. I mean, changing the zones and making it easier to qualify, easing up on the regulatory, I think, components of opportunity zones. So definitely something we're looking at is how we can also kind of support investors through this. For our audience too, I think we were premature in a poll question. We may try and rerun this about if you think, what do you think about opportunity zones? If this looks like a compelling investment opportunity, it's pretty fascinating. Do you guys, I don't even know who to direct this question to, but who wants to kind of opine a little bit on the debate that occurred to get us to this? And then I feel like the consensus is we're kind of in a dead zone between now and probably 2027, when the new zones are defined and when they've provided more guidance on kind of what this new opportunity zone structure is going to look like.
Yeah, well, I'll just say this one, like some of the other programs, really was driven by the administration and Treasury and getting in. And, fortunately, it is in because, Heidi, we have a lot of things expiring under the old program that I think, create some opportunities in the new program. But obviously, it's complicated, right? These calculations are complicated. How do we make those transitions? Now is the time to be, if you're the accountant here on the program, to really be understanding those rules. And maybe we can get a white paper out to everyone about those, because it is complicated. It comes with a lot of calculations. But I think, Ryan, you guys helped a lot with this as well. I just think it's tremendous that it is here, because this one I didn't think would survive either, but really came from the administration side.
Yeah, I like the opportunity zones issue a lot. I mean, I think it's become somewhat of a niche for people that specialize in it and people that are involved. But for people that are active in opportunity zones, I mean, they are deep into it. They care a lot, and they're bringing a lot of capital to these low-income communities. The estimates are well over 120 billion that's been mobilized for OZ investment so far. So again, here, permanency in the Senate bill, which was included in the final version, is huge. So that there's not going to be that kind of uncertainty going forward. Heidi, I agree with you about, there is this difficulty now until the new zones get named. We do think that there's some things that can be done to help there, and we're working with Treasury to get some transition relief and at least some certainty for projects that start now but aren't finished necessarily at the end of 2028 or beginning of 2027, just to make sure that they realize that they're going to be fully covered. So, but one of the great things about opportunity zones is, in contrast, and no offense to anyone on this call that may be involved in the new markets tax credit, but that's a competitive thing. You have to develop a really long, expensive application, submit it to Treasury, put it in this black box, and hope you get a credit back from the Community Development Finance branch of the Treasury Department. It's a very cumbersome thing. Not a lot of people want to do it. Real estate developers want to move quickly and fast and try to get projects off the ground. You can do that with opportunity zones. You just basically have to make sure that you comply with all the rules, and then you are eligible for 3 very significant tax incentives at the front end and at the back end of the investment. So it's a great program. They did narrow it quite a bit by lowering the income levels. So you're going to have a lot of tracts that are no longer eligible to even be designated by governors, because the income cap's gone from 80% to 70% of area-wide median income. But that could be a positive thing in some ways too, because you could end up seeing more development where it's really needed. And one of the biggest criticisms of OZs is that it's gone into places that don't need the investment. So, and then you're also getting information reporting and transparency out of this new statute. And that was a big priority for members of Congress on both sides, who just felt like they didn't have a lot of data on what this program had accomplished over the last several years. And so getting that kind of information reporting from investors is going to, I think, be really good for really establishing the benefits and community benefits, economic benefits of the program. So there's a lot of, I'm not going to get into all of the implementation issues associated with OZs unless people want to, but it's a very technical program. And there's a lot of hoops you got to jump. There are things you have to, comply with. But I think that by and large, what they did in the One Big Beautiful Bill Act is going to be really helpful going forward.
Yeah. Heidi, I would also say that in the opportunity zones, there are so many other incentive programs, like work opportunity tax credits and other incentive programs. So if you're on this and you're listening and you're in an opportunity zone, or you're also looking to go into an opportunity zone from a business perspective, make sure that you look at the all the incentives, right, and that are in those areas, because those are really loaded up areas with a lot of incentives beyond the opportunity zone benefits as well.
Yeah, absolutely. Yeah, well, and the new opportunity zone regs have really expanded this to more rural development. So we expect some changes on kind of the farming agricultural side, which is an interesting shift. Yeah, so there's some interesting components to it. I think for the real estate people and the CPA accounting group here, one of the key takeaways I've shared that I don't hear talked about as it relates to opportunity zones is, I think the biggest opportunity is that when you compare the option of either doing a 1031 exchange or using an opportunity zone investment, there are scenarios where one can be much better than the other. 1031 always is going to do a full deferral and roll into another property, so there's no tax implications, obviously, on the sale of the property. The caveat to a 1031 exchange is that an investor has to reinvest the entire amount, 100%. So they sell that asset, all of which needs to go into their new investment. The opportunity zone has this component that they only have to reinvest the capital gain portion. The original basis can actually be cashed out. So opportunity zone investments do allow for investors to be able to actually pull some capital that they wouldn't have been able to pull out of an investment before. And again, just reinvesting the capital gain to defer the capital gain on that. And then, after 10 years, a full step up in basis, so they can, essentially sell it tax-free. So that's one of the biggest things in terms of long-term planning, is to understand for investors, if they're looking to free up some cash or some capital for something else, the opportunity zone is one of those structures they can actually allow them to do that, which makes it very, very unique and competitive in a 1031 exchange comparison. So I think
Heidi,
that's
Heidi, what a great point. It really should be for everyone here on the webinar, part of the tax planning, right? You got to look at this strategically in real estate, right? And think about how you're selling your property, how are we going to tax plan for the taxes associated with that. And this is one area you have to really look at. 1031, you have to look at opportunity zones and other programs. But I think definitely this is one that you have to at least, take a look at it and advise your client, right? And see if there's benefits there.
Yeah.
Yeah,
Absolutely.
I'd like to jump in too on that point. I think a lot of people, when this started, the opportunity zone was just this, buzzword, and everyone was doing a fund and going into an opportunity zone. A lot of people didn't realize and didn't understand that the gain, the tax liability for that gain is going to be due in the 2026 tax year. So when they file, when anyone who went into an opportunity zone fund has to file their taxes in 2027, they may be surprised to see a large tax bill that's due to them on the capital gain that was deferred for that long. Now, a lot of people might get the 5 or the 7% step up in basis at that point, but there's still going to be a big capital gain. I think there's a lot of people who neglected to educate investors on that date, and I think we're going to end up having some issues there where people are going to have some big tax bills. Now, the opportunity zone funds that I went into, I made it very clear that I wanted to understand what the plan was for the fund, and it was one of those things that I knew about, and I wanted to ask those questions. And most of them are planning to refinance in the 2027, early 27, to help pay for the tax liability that's going to come due. So they're cognizant about it, but there are a lot of people that didn't. They weren't looking at that. They didn't understand. And also, I think we're going to be, trying to implement a new service of valuing those assets in 2026, because that's going to be a big push as well. And that's going to be a big need that's going to come. And it's coming quick. 26 is right around the corner. So if you're a CPA on this call and you have clients that invested in opportunity zones, please do them a favor and make sure that they are prepared for that tax liability that's going to come due in 27 when they file their 26 taxes. I think people are going to get caught. So I just wanted to put that out there because I think this is a good platform to talk about it.
Yeah.
Kim, an important issue you bring up, because how would the accountant know their clients in a fund that's in an opportunity zone and looking at serious consequences, as you say? So maybe the accountants here, maybe they should reach out proactively, right? And just ask
100%.
because now's the time to do it, right?
Yeah.
Yeah. If there's an opportunity zone, investment on their books, they have got to have the communication. Don't put your head in the sand. It's, because ultimately, taxpayers like to blame the CPAs, right? You didn't tell me about this, or, and just to prevent that, don't put your head in the sand. If they are going to have a tax liability, make sure they know, even if you think they know and they're a sophisticated investor, please go back and do them a favor and just let them know that, hey, coming in 2026, you're going to have this massive tax liability that you're going to have to, any of those capital gains that you got relief on, you're going to have to pay tax on that. So,
yeah. And Kim, I would add that, if you're a real estate investor listening, now would be a great time to start telling your accountant and telling them that, hey, we should start some tax planning around this, because tax planning, this code does allow you different ways to lower those tax liabilities and manage them. A lot of things that you do to lower those tax liabilities have to be done before midnight, right, on New Year's Eve. And good point. And if you're the real estate investor, make sure you're sharing this with your accountant now.
Absolutely.
I would just say that if you invested in 2018 and you're realizing that it would gain in 2026, you probably did get a pretty nice inflation benefit that you weren't necessarily expecting in 2018, because boy, did we have some high inflation, right, coming out of COVID. So that deferral has turned out to, for a lot of investors, agree, you are going to get a bill, but you also got a nice benefit associated with
that's a great point.
Yep.
That's a really good point. Let's jump into clean energy and the energy efficiency incentives. Certainly, there were a lot of changes in this bill that was a rollback of some of the clean energy, the repeal of certain incentives. So one specifically is 179D, which we want to talk about primarily because, of course, this is one thing that at Engineered Tax Services, we have done the certifications on for, well, since it was originally passed, 20 years ago. So Kim, do you want to give us an overview of the changes to 179D?
Yeah, so essentially, the 179D is been rolled back. So essentially, you have to have projects to start construction before June 30th of 2026 to be eligible. They do have some inflation adjustments. It was increased to the $5 a square foot in the IRA bill, but there were some provisions that were put in place that made it very much more difficult to get those meeting the prevailing wage and the apprenticeship rules. We're still based on the ASHRAE standards of 2007, which is easy to meet. And it does open up to, it's not just the HVAC and the lighting and the envelope anymore. Now it's actually looking at everything in the building. You're looking at the solar, we're looking at EV stations, we're looking at anything that is contributing to the energy use of that building. And those inflation rates, it makes it about $5.81 a square foot for the 2025 rate. And it is expected to jump again for 2026 and increase again for inflation. Again, there is still opportunity. We're still writing these studies out there. Still a lot of architectural firms that are eligible to claim these deductions under the allocation rules for government projects. But know that, if you've been kind of living high on the hog and you've been collecting the 179D, many of our architectural firms are in, a situation of loss, and they're using them and they're kind of eating those up. Make sure that you go back and get the last few projects that you can to carry those forward into future years and be able to use those deductions. So it is going to be, going away. And this is something that's been a long ride, 20 years. Like Heidi mentioned, we've been doing this since the inception. And, it's something that we're very, it's been near and dear to us. This is actually what brought me into the industry, is this tax code and this act. So, it is going away. So unfortunately, but let's big push on the very end of it.
Absolutely. Yep. Again, very strategic tax planning. We'll dig into that again, the importance of this for architects and engineers who have been riding this for the last 20 years and probably have not paid any tax since then. This is really where R&D tax credits could potentially come into play to help offset the difference that they're going to realize when they cannot claim 170/90 any longer. But again, this is still in place for projects that have started construction up until June of next year. So we will still be filing claims all the way into 2027, probably even 2028, because you could have a project start construction first quarter of 2026, doesn't finish for 18 months, and they can claim the 170/90. So it still will actually be around for a little while, given the start date of construction. So just be aware of that. But it is expiring after that stage. Moving along, we have a couple more slides, and I know we're getting short on time. So let's dive into the SALT deduction cap increase. This is something I've had a number of questions on. We really don't deal with SALT, state and local tax. But Ryan, do you have some insights on how this came to play? Is this anything you guys have been involved with?
Well, they had to deal with SALT in order to get the votes. It's a very narrowly divided, especially in the House, and that's really the only place that mattered. The Senate didn't really care. Senate majority didn't care very much about this issue, but there are enough Republicans in high tax states still in the House that this was something that had to be dealt with. And Roundtable has members on both sides of the issue. We have members in Florida and Texas. We have members in California and New York. So it's not something we advocate per se on. Our concern was there was talk very early on that SALT would extend to business SALT taxes, and there would be new limits on, for example, business-related property taxes. And we thought that was very serious for a while. It was coming out of the House Budget Committee. But at the end of the day, that got dropped. Fortunately, I think it would have been disastrous for real estate. And they raised the caps on the individual for a temporary period of time. And depending on where you fall on the income levels, this can be a huge, significant new benefit. So it goes up to 500,000, and it raises the deduction cap up from 10 to 40,000. So the relief is significant.
Absolutely. Next one is the mortgage interest deduction. So what was changed in the bill with mortgage interest deductions?
Yeah, mortgage interest, they're basically just extending the 2017 law's reduction in the cap on principal acquisition indebtedness from 1 million to 750,000. You also continue to not be able to deduct interest on home equity loans. And this was part of the basic individual reform package that doubled the standard deduction and eliminated personal exemptions, doubled the child tax credit, and they're effectively keeping those limitations in place going forward. The individual reforms are largely, I'd say, unchanged.
Got it. Yeah. Kim or Julio, do you guys have any comments on this one?
No, in the timing wise, I think we can probably let it go there.
Yeah, I think so.
Never getting close.
Yep, absolutely. Well, with that, because we have a couple minutes and we may be able to stay on for a couple of extra minutes and answer some questions, I do want to let our audience know that there are QR codes here for contact information for each of us. So if you guys have any questions, comments, you want to schedule a call, these are links that go to all of our contact information or the ability to do that. I think we have one more poll question. Also, we've got the /tax podcast where I work hard to interview a lot of these amazing people. Julio recently shared his story about founding ETS. Julio's, again, social media is a fantastic resource. And we're always working to share valuable information, including his book. So again, make sure and click the link in the chat to get a copy of his book. So with that, and just taking a couple of extra minutes before we wrap up, we had a few questions, a number of questions actually. So let's just dig into a few of these. So I don't know who wants to answer this, but there were actually a few as it related to opportunity zones. So how popular are the opportunity zones with investors? The comment was, every investor that I've brought to them didn't like them much. So I'm curious to your insights on why it's been, I think it definitely was not as well received as people thought it would when this was originally passed. Any thoughts on that?
Ryan, how's it impacted the members of the
Yeah. I mean, so much of large real estate, it relies on institutional money, pension funds, sovereign wealth funds, insurance companies. And that's not what opportunity zones are about. Opportunity zones are kind of about high net worth, generally high net worth individual investors. Some people have just built out platforms that have been very effective, and they know how to attract that crowd, and they've built funds and been successful. I think a lot of people have tried to do it and kind of failed. But so it's weeded out some of the people that have tried to get involved in this area, and others have really developed a specialty. And then you've got other people that are just doing a single asset, and they have their own gains, and somehow they're able to make engineer kind of an opportunity zone benefit from a single asset investment. So I wouldn't say, relative to these other general rules, opportunity zones is very much a segment, a niche area of practice and specialty.
Fantastic. Wonderful. Another question, is it true that 2024 R&E can be treated or capitalized or expensed in 2024? This is actually a research and development or research and experimentation question. Is it true it can be treated, capitalized or expensed in 2024 independently of 22 and 23? Kim, do you want to respond to that one?
Yeah, it's going to depend on the limits, right? So if you're over 31 million versus under 31 million. So if you're over 31 million, the answer is no. If you're under 31 million, the answer is yes. So it just depends on where your clients lie, or where you lie as far as the revenues go. The treatment is a little bit different. So I think we don't have a lot of time to dig into that, but for that question, we'll have to email us.
Yep, absolutely. Yes. And we will, there were a lot of questions. We are recording the webinar. You will get an email after this with a link to that as well. So if you want to replay it, watch it, or share it, that will be available. We'll put it on our YouTube channel as well. So Engineered Tax is on YouTube. So we put all of our recorded webinars on there, which can be a great resource. I think final question, and Julio, this is a good one. What other incentives, tax credits, et cetera, are available in opportunity zones? I think this can kind of be a broad answer as well, because again, this comes back to the question I asked with low-income housing credits is how can we stack opportunities to really improve ROI? Do you want to talk for just a second about how all of this pools together and some of the things that can apply?
Yeah, I mean, what I see the most, right, are the employment tax credits at the state and local level that seem to fit well into the opportunity zones. We have a lot of incentive programs at the state and local level that how the capital stack in these real estate investments in the opportunity zones as well, right? And so even if they weren't in opportunity zones, they're in areas that, you know, qualify for a lot of these incentives. And Heidi, you know, maybe you can share a link, because if you have projects, we can run an incentive report for you, and that's to look at your property projects there and see what other opportunities there are, because every location is going to be very specific and different.
Yeah, absolutely. Yeah, you know what we can do is we can actually share a link out to all of our attendees today. We have actually acquired a platform in the last 2 years that creates engineered incentive reports. What these are is, in essence, we can look at a business owner, we can look at an investment opportunity, we can look at the address and what you're looking to do and identify any state, local, or federal incentive that would apply to that project or that business. I don't know that there's a database like it. There's over 3,000 incentives built into our database, and we're so excited to be offering it. When we have events like this, we are offering those for one person or one client free of charge, and looking at where those opportunities are. So give us a shout if you're interested, and we can send you a link to enter a few details and see what's available for you. With that, we're a couple minutes over, so I'm going to wrap it up. But this was really fun, amazing. Thank you so much to all of you for being here. Ryan, we're so appreciative of you being part of our group and coming in to join us on this webinar. Your expertise and knowledge is tremendous. So thank you all to our audience. We'll send emails out after the fact, and we appreciate you joining.
Thank you, Heidi. Thank you for the invitation.
Thank you.